This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. The Fed keeps interest rates at a two-decade high, but Jay Powell says a cut could come as soon as the next meeting in September. Asian stocks are set to follow Wall Street higher, boosted by those dovish comments. Nvidia adding a record $329 billion in value. Meta jumping in late trade on a sales beat. Plus, the yen surges to March highs against the dollar after the BOJ rate hike, punching through that key 150 level. We do have some more just data crossing the Bloomberg, adding to the broader picture here when it comes to Australia's state of play. We're getting the Judo Bank Australia PMI for the manufacturing sector. This is a final reading for July, coming in at 47.5, so slightly, really just marginally a little bit higher than the prior reading of 47.4, but still very much firmly in contraction territory. We do really have that reaction when it comes to the bond markets, with the RBA kind of, at least for now, taking further rate hikes off the table after that CPI number came in cooler than expected. We also had sort of further feeding when it comes to the narrative of the cooling in the broader economy, with the house price growth data showing a slowing in July as well. These elevated borrowing costs, sticky inflation picture really weighing on demand. Melbourne in particular declining for that fourth consecutive month. But of course, so much of this really centres around central banks, right, Shery? We had, of course, the Fed. Not a great deal of surprise. We knew that they were likely to wait until September, but certainly that stronger signalling, despite the risks on both of the sides of their mandate, really looking ahead to that potential easing as soon as September.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
What was really interesting was that Chair Powell's comments sounded a little bit more dovish than the statement itself. The statement did, though, make some adjustments, especially when it comes to really focusing on the labor picture as much as inflation. It said that there are risks to both sides of the Fed's dual mandate. And of course, it was really this sort of dovishness perceived by the markets that moved the Japanese yen as well. Remember, we had the BOJ's rate hike. We also had more details when it comes to those bond purchase reductions. Take a look at how the yen is trading at the moment, because we saw it rally in the overnight session to a 5-month high against the U.S. dollar. We saw also JGB yields climbing as far as 1.083% before paring back some of those gains. But it's really about the idea that the BOJ is really ready to continue hiking rates. And if you take a look at the future space, this is what it looks like, because we have continued to watch those bank stocks in Japan. We saw that rally on speculation that the Bank of Japan will be able to hike even more. And we continue to watch some of those earnings results, because we just got the UOB, Singapore's lender, that they came out with their net income at 1.49 billion Singapore dollars, slightly beating estimates. So it's really a busy session when it comes to both the monetary picture, but also, of course, the earnings picture. And it's really about what the Fed is going to do next, as we have other central banks also to watch out for, right? I mean, we are talking about the Bank of England being next in line. We're expecting its first rate cut since the pandemic. But let's talk a little bit more about what happened with the Fed overnight and bring in John Taylor, professor of economics at Stanford University, and of course, the creator of the Taylor Rule. Professor, great to have you with us at a very timely moment when it comes to Fed policy. First of all, what did you make of the dovish comments coming from Fed Chair Powell and that potential move in September?
I think, first of all, the fact they didn't make the change today, a lot of people speculated they would, and they didn't. I think that's important. Also, he was kind of guarded on the extent to which he'll have to do more later. I think it's both a signal that we may do more, we may not do more, but it's leaving things open.
According to your Taylor Rule, you have said that the rate could actually come back down a little bit. About 5% is sort of the level. Is September the right time to start cutting to that level? Because right now markets are pricing in at least 2 rate cuts this year. What are the risks?
Yeah, they have been pricing in a rate cut even this time, and the Fed surprised people a little bit. Yes, the Taylor rule is I'm glad you mentioned that, it's a little bit in the edge at this point, but don't forget, and Powell mentioned this several times, the target inflation rate is 2%. And so if 2%, you're going to have a couple of points for real, that's 4%. And so we're not too far away from that, and we'll have to see how far they go. I think that they made a good decision today. They didn't ease where they didn't need to, and they left open the possibility of easing later.
It's certainly not a sure thing, right? Even though the markets will take, any kind of dovish angle and really run with it. I do wonder how much uncertainty and volatility do you sort of price around the election outcome, and whether some of those, pro-growth, which would also be pro-inflation, one would assume, policies and the trade policies might start to complicate the picture for monetary policy.
Yes. I think the Fed was wise not to do much today. They're going to have early November, of course, is the next. They have 3 more moves coming up in early November, and so there'll be a big question about that. Maybe they'll move in mid-September because of that. But I think there's a big speculation now about what the Fed is going to do, and this stabilized things a little bit. It really made it clear that they were not about to make some big changes in advance of the election.
This term of just normalisation was kind of intriguing to me as Fed Chair Powell was characterising the shifts that we're seeing in the labour market. Do you see that as just normalisation? Is it sort of another word for, I guess, transitory towards something, that's going to look a little bit different in a few months' time?
I think it could look different. Actually, it's very important to take into account where the funds rate was 2 years ago. It was 9.1%. It's come down a little bit. The inflation rate was really quite questionable. But now we're in a better situation. The inflation rate is getting close to 2%, not 2% yet. And they've emphasized that quite a bit. So I think that they are in the right position. They need to move a little bit more, my guess, but we'll see if they will do that. And the question is, going forward, are they going to do more or less? And here, I think the rest of the world is very important. You mentioned a little bit about the Bank of England and of course, the Bank of Japan is very important, and the Bank of, you're close to that, and the other banks as well. And so it's become a global issue, and we'll see what happens globally.
Professor, you were in Tokyo just a couple of months ago at a BOJ event. Tell us a little bit about what this divergence in monetary policy, now that the BOJ has started hiking rates, could mean in terms of the risks that we should be watching out for.
I think it was a good move that they have raised rates a little bit so far, just a little bit, and it's in the right direction. It's really, really where the world is going at this point. We have a very high rates in different parts of the world, Latin America for sure, Africa certainly for sure, and even Europe has begun to make some change. So I think that this goal of 2%, which is what the Fed is focused on, what Jay Powell mentioned a few times, is not a bad goal to have globally. And I've argued for that for years and years and years, and I think that would be a goal. It's not 0, it's not 1, it's not 5, but it's 2. It's easy to remember, and it's something that the central banks can aim for.
At the same time, we continue to see critics about that 2%. Some call it very arbitrary, made at a time when you had high private debt, not to mention weak economic growth. What do you make of those arguments?
Well, the 2% has been the subject of a lot of research over the years. It's not 1, it's not 0, it's not 5. And so the idea of 2 is a round number. It's something that's central banks can focus on. In fact, think how many times Jay Powell mentioned that. It's in the reports as well. And so I think it's important to doing that. And one thing that also is important about the Fed is that they have really made a little more specifics in their reports about how they're doing. I think that's a very important part of things. So the important thing is to be more transparent And I think they're becoming more transparent. They weren't too transparent 2.5 years ago. I think that's an important thing now.
John, always great to have you with us. We appreciate your time. John Taylor, Professor of Economics at Stanford University. Garfield Reynolds leads our Markets Live Asia coverage and joins us now. So interesting sort of some of the points that John was raising earlier, particularly as to, I guess, just a degree of uncertainty in the data in the next few months. Yes. Do you think markets have taken, too much dovishness from what Fed Chair Powell said?
Well, I mean, it's a tough one. I don't want to, trash talk markets too badly. I mean, the key thing is you have to remember markets are very much about not so much what is possible, but what is probable. So the overwhelming probability, if the data keeps moving the way it's been moving, is that the Fed will cut rates. I mean, that was the message that Powell confirmed. I mean, it's a truism, and it's completely useless from a trader and potentially even an investor viewpoint to say, well, if we get 2 inflation reports that beat to the upside, then the Fed won't cut rates. Well, of course it won't, or it's very unlikely that it would. But when you're looking at the likelihood of what can happen, you're going to say it's going to take 2 very nasty CPI reports and probably a very nice labour market report, because Powell sounded very concerned about the labour side of the equation, for the Fed not to pull the trigger and cut rates next time. So that's the base case. The bigger question is how, for investors really, is how much of that rate cut has already been priced in a lot of ways for markets, and how much of a concern is it not just will the Fed cut in September, but how rapidly will it move from then on going forward? That would be my bigger worry, is that markets, they may well not be jumping the gun when it comes to a September cut, but you've basically got a consensus pretty much that they're going to cut in September, November and December. That's close to what's being priced anyway, and certainly twice. And then I think it's something like 6 cuts through to late next year. That's pretty aggressive, and you would need both for a lot to go, as it were, wrong with the data, and for a lot to go right with the actual impact of the economic slowdown on companies for some of the more bullish equity investment positions in particular to come to pass.
The reaction of the yen was really interesting, because post BOJ was almost like met, right? Do you think that's more of a function of kind of the messiness of the BOJ release, the communication, or is the Fed, it's the dollar doing the heavy lifting here at this point?
No. There's a lot to be said for the idea that the BOJ, I was thinking yesterday when we were sitting there waiting, when is the decision going to make, and the website crashed, and thinking, no other major central bank does this. Everybody says we're going to announce at this time, and they do announce at this time. So for whatever reason, the Bank of Japan does not pursue that methodology. There is also, I think, what very much weighed on yen traders' minds was that previous times, even if the BOJ has sounded clear about what it's doing in the statement, Ueda has walked things back. This time round, he walked things forward, and that made a lot of difference. And in fact, the yen had done a lot of rallying before the Fed, and actually retreated after the Fed statement, but then re-rallied after Powell. So the Fed did some heavy lifting, but the BOJ did a lot of heavy lifting when it came to where the yen went.
That was interesting how the yen really made a comeback afterwards, right? And tell me about waiting for that statement. I was baking in the sun outside of the BOJ at 30-degree heat. So it was quite a day. So exciting when it comes to all these central bank decisions. But we've also seen a lot of excitement when it comes to tech stocks, right? I mean, this rotation out of tech stocks, because we're expecting these rate cuts to come from the Fed and perhaps go more into cyclicals. At the same time, now we have more news flow about potential restrictions against chip makers, especially here in Asia, especially targeted against South Korean chip makers for selling to China. What will this do to the broader market dynamics?
Well, your best case scenario, if you're a broad market investor, is precisely that equities continue to climb, but that they rotate away from the megatechs, because nobody could feel that it was sustainable to go on having just about everything being driven by the so-called Magnificent Seven. Sometimes people think it might be better off Magnificent Six plus Tesla. But however you calculate it, that extremely narrow focus for much of the past 6 months rally had been gnawing away at investors, thinking this can't go on. So do we get a rotation? And the Fed cutting would be one way that would allow for it. So there's that going on. There is also a feel that the AI boom could have peaked, both because of those concerns you raise about the potential chip curbs going on, and just also because they've flown so high, the valuations got so extreme that you couldn't rely on them continuing to shoot the lights out, especially on the equities performance situation. So to see the market potentially rotating away from megatechs is going to be taken as a very healthy sign by most investors, I think.
Catherine Reynolds, who leads our Markets Live Asia coverage here. More ahead on the Asia trade. This is Bloomberg. Take a look at some of the tech stocks that we're watching at the moment, and it was a big sort of session when it comes to, of course, the relief rally, largely spurred on by the Fed. But take a look at some of these sort of more idiosyncratic stories there. Obviously, Meta is one to watch there. We still see quite a bit of upside to the tune of about 7%, better than expected sales for that second quarter. Some proof that Meta's investments when it comes to AI are starting to help when it comes to the sales and ad side of things. We're also seeing quite a bit of downside for the likes of Qualcomm, as well as ARM. ARM, they're taking a slide with that tepid annual sales forecast in play as well. Let's get some more on Meta, though, with our tech reporter, Kurt Wagner. And this sort of fit in with the narrative that has been depressing and worrying so many tech investors, right, that the money spent on AI expenditure has yet to pay off. Was this evidence to the contrary?
A little bit, because Meta's ads business obviously had a great quarter. They beat on revenue. Their projections for the third quarter were sort of better than expected. And a big reason that they're saying that this is the case is that they're using AI to, show better targeted ads, to show more personalized ads at the right time to the right person. And so they have a narrative now around AI that is, not just a futuristic thing, but something that's actually helping their business today. And, they are talking a lot about future technologies as well, but I think it helps when, you report a strong quarter like they did today.
Mark Zuckerberg, though, still has preached patience with investors. What else have we heard that we should be watching out for?
Yeah, he is. I mean, he talked almost the entire call about artificial intelligence. He talked about the smart glasses that they're working on with Ray-Ban. He talked about the large language models they're using to power, these AI chatbots. He said that eventually every business, he believes, in the world will have an AI chatbot as some type of, customer service agent. So these are, potential business lines. He talked about Threads, their ex-competitor, and it's close to 200 million monthly users now. But these things are things that he says are future benefits to the business, right? They're investing in them now. They're not really contributing to the bottom line today. He hopes that they will eventually, but that's why he's preaching that patience, is he says, look, we're investing in things that may not come around for a couple of years, but, stay with me because they will eventually.
Our technology reporter, Kurt Wagner, there with the latest on Meta. Now, staying with tech, the U.S. is said to be considering new restrictions on China's access to AI memory chips and equipment, a move set to further escalate their tech rivalry. For more, our China correspondent Mimi Lo joins us in Hong Kong. And Mimi, what was really interesting is the sources are saying that these new measures will be designed against South Korean firms like SK Hynix and Samsung.
Yes, that's right. These latest rules that the U.S. is considering is really targeted at the most cutting-edge chips that are required for artificial intelligence. And these are your HBMs, the high-bandwidth memory chips that are made by companies like SK Hynix, Samsung, Micron as well. And if these new rules are enacted, they will prevent these companies from selling the chips as well as the equipment needed to make them to China. Now, it's not clear yet how Washington will impose these restrictions and one method is to invoke the FDPR, that is the Foreign Direct Product Rule, which allows Washington to impose controls on foreign products that use even the tiniest bit of American technology. And we know that companies like SK Hynix, Samsung, they still rely on US chip design software. Micron is less likely to be affected because they have largely refrained from selling HBMs to China after Beijing had banned Micron from critical infrastructure last year. And this is part of a broader package that could kick in as soon as next month that will also see the US imposing sanctions on over 120 Chinese firms, which will be included in this so-called entity list that will designate them as a national security threat to the US.
We've been told that the US could consider exemptions for allies, including the likes of Japan, the Netherlands. What do we know?
Yes, this was first reported by Reuters that the US may consider to exempt companies from Japan, Netherlands, and that means companies like ASML, Tokyo Electron, they may be unaffected for now. And that's why we saw those stocks jump yesterday. But experts are warning that investors are bidding these stocks higher, thinking that these companies may be allowed to trade freely with China, but that may not be the case. They may be exempted because these are the countries that are most likely to align with the US anyway, even without the need to invoke the FDPR. And the fact that Washington has the power to invoke the FDPR at a future date as punishment if these companies just veer too far away from US policies, that's always a consideration as well. There's also the consideration that, these companies could be pushing back against the US in consideration of their profits because China is still an important market for them. There's also the flip side argument that the FDPR could backfire if these companies are motivated to then stop relying on American technology altogether. So plenty of arguments and different considerations here. I think we have to wait and see what the final package will look like and what the eventual implications would be for the market.
Our China correspondent Min Min Lo there with the latest. In a few minutes' time, we'll be talking about how these new chip curbs may impact the global tech sector. Deepwater Asset Management will be along with their views. This is Bloomberg. Let's get you caught up with the latest in corporate headlines. We're tracking Boeing's next CEO, Kelly Ortberg, says there's much work to be done ahead for the plane maker. Ortberg is being hired out of retirement after rising through the ranks at aviation supplier Rockwell Collins. But the scale of the turnaround task he faces was immediately highlighted by a company warning that third quarter cash burn could reach $10 billion. BYD's ADRs closed higher following news that the Chinese EV maker is looking to enter the Canadian market. Lobbyists for the company have filed notice just as the Trudeau government wraps a consultation on measures to restrict Chinese imports. Meanwhile, Uber will team up with BYD to put 100,000 EVs onto the ride-hailing company's platform. The tie-up will begin in Europe and Latin America and will not include the United States. Take a look at how we're tracking when it comes to US futures at the moment after we had, of course, really the reaction to what was seen as a far more dovish power perhaps than all things had been indicating, saying that the Fed could cut rates as soon as that September meeting. We saw that big stock rally really continuing into that futures session, including, of course, the rebound that we've seen following the big tech sell-off. More ahead on the Asia Trade. This is Bloomberg.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. We have made no decisions about future meetings, and that includes the September meeting. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
And that perception of a dovish Fed, not to mention, of course, the BOJ tightening policy. In the previous session, we actually saw stocks supported across the board in Asia. Take a look at futures trading at the moment as we continue to see perhaps some extension of those gains. Nikkei futures down more than 1%, though. We were watching, of course, U.S. futures as well after we saw the best day for the S&P 500 since February. But Heidi, what a wild ride it's been for NVIDIA, adding $329 billion in value this week.
Yeah, making even assets like Bitcoin look quite stable, right? But as you mentioned, Shery, we did see that bounce back when it comes to big tech, that move in NVIDIA. Meta also soaring in the late trade. I think we're still up by almost 7% at this point on that sales beat. Let's bring in Jane Munster, who's a managing partner at Deepwater Asset Management. Jane, great to have you with us. And volatility is kind of the thing that we're watching here, right? Because fundamentally, I wonder, even with this rebound, have the fundamental concerns about spending on AI, where to next for investors that are more hungry for returns and evidence that this is paying off, has that really changed?
It hasn't, and it's still a year, 2, 3 years away, but it is a path that patience will pay off for investors. So on Meta's earnings call, that piece, that was the first question that came up, was related to CapEx. They guided CapEx a little bit higher than what they had talked about last quarter. So it's going to be up about 50%, and you're hitting to what I call the pressure point, that when is the return on this investment. And when Zuckerberg got asked the question, he basically broke it down into 2 pieces. They have a core AI opportunity, which is basically infusing AI into their existing products. That's a nice opportunity. But he said the real opportunity is related to generative AI. They haven't even started to launch any of those products. That is where this massive CapEx investment is going for across mega cap, is related to this next phase. And he said we're years away from that, but it will be collectively much bigger than their existing business today. And so patience is going to be a virtue for investors when it comes to investing in AI.
And investors, for Meta at least, seem quite convinced, right? Do you think that patience is going to be a long-term thing that they can hold on to, given, as you say, we're still years away?
Absolutely. I think what we're going to see is continued momentum in investors' belief that ultimately the substance of AI will exceed the hype. And I just want to kind of put this into context, is that Meta shares, this is related to the opportunity around AI, Meta shares going into the call were up 4%. And the call did not have any one point where the trajectory of the call changed. They're currently up about 7%. That 3% move is related to investors essentially buying into Zuckerberg's vision of what AI can do for their business. And he described the frustration that some investors have at the number of CEOs that talk about AI nonstop on their earnings calls, and added that the reason why that happens is this opportunity is just that big. And so I think that I've known and watched and invested around Zuckerberg for a long time, 15 years. And I think what he expressed on today's earnings call was a change in his ability to really, I think, get investors behind their vision. And so I think investors will be patient, because this, again, can be more transformative than I think what most expect.
In the meantime, other than using AI for those targeted and personalized ads, how much more can you do in order to squeeze returns?
So their core business, if we think about AI, that they have pieces around, like you said, targeting and generating content. The 3 big areas on the generative AI is Meta AI. This is this chatbot that they recently announced. They said it's the most used generative AI chatbot in the world. Probably true. Second is related to AI Studio, and that's going to be the ability for anybody, a person or a business, to build their own personalized AI agents that can do what you want them to do. And third is just related to Llama more broadly. They talked about Llama 4 coming out next year. The compute requirements are 10x what Llama 3 is, but those are the 3 kind of cornerstone pieces about what Meta can ultimately add to their AI story in the coming years.
And Jean, broadly speaking, at a time when we're seeing this exuberance of artificial intelligence, we continue to see this divergence and bifurcation when it comes to the chips, the AI chips being supplied for this boom. We are hearing about more restrictions coming potentially from the Biden administration against China acquiring this technology. How will this play into the markets long term?
So long term, I don't think it matters. And this is an uncomfortable thing about AI, is my belief that this is going to be significantly bigger of an impact than what the internet was. I think the opportunity for wealth creation over the next 3 to 5 years will make the .com chapter look small. And so when I think about those near-term events, think about restrictions, trade restrictions, how that could impact, for example, NVIDIA's or TSMC's or AMD's business in the near term, undoubtedly investors will be concerned over a short period, months, quarters, maybe even a year. But if I'm right on this trajectory, I think that ultimately this is noise. Inflation is noise. I think government regulation around how these models can be trained is noise. This is that transformative of a technology. It will be that embedded. It'll be just the fabric of so many businesses. So I acknowledge that stocks will trade on these headlines, but at the end of the day, it just doesn't matter.
We also have Apple and Amazon to look forward to as well, right? What are you watching out in particular for these announcements? And I guess, you know, Apple doesn't give guidance anymore, but to that forward-looking piece, what would you be watching for?
Amazon's pretty straightforward, of course, the AWS number, and in terms of related to Apple. What's most important is related to the timing of some of these AI features. They said at WWDC back in June that these Apple Intelligence and these kind of exciting features that are going to be in their next generation hardware is going to roll out over the next year. And so I think that's something that people will be keenly tuned into. Also, the China piece, China macro has weighed on the business. It's been down for 3 consecutive quarters. The street's looking for it to be basically flat. And so I think investors are looking for the China business to actually start to grow again. Biggest picture, I think the takeaway from Apple's call tomorrow, similar to what happened with Meta tonight, I think investors are going to leave this with a better understanding that the next 2 to 3 years are going to be some really impressive years. And as you said, they don't give guidance, but I do expect some of their commentary will be supportive of street estimates that we're going to see accelerating growth in the September quarter, December quarter, and then into 2025.
Jay Munster, always great to have you with us, Managing Partner at Deepwater Asset Management. Taking a look at how we're seeing crude markets at the moment, of course, not to central banks, but a great deal of volatility when it comes to geopolitical developments. We saw oil just extending that jump on this report that we've heard that Iran has ordered a retaliatory strike on Israel for killing a Hamas leader on its soil. That is according to the New York Times, and we're seeing that still play out when it comes to New York traded crude at the moment. That report saying that Iran's supreme leader has ordered that direct strike on Israel in retaliation for the killing of Hamas's political chief in Tehran. Let's bring in Bloomberg's Michael Heath for more. And we were talking yesterday about what a retaliation might look like, and boy, did things escalate in the hours that followed, right?
Yeah, I mean,
I do wonder, is this retaliation going to be like the previous instances where, you know, it's well flagged, it's more symbolic, or is this really quite risky?
It's definitely risky, Heidi. I mean, we've had two. We've had the attack on Hezbollah and then the one in Tehran as well, which Iran's responded to. And it's quite embarrassing for Iran, that one as well, because it's obviously the president's inauguration. The Hamas representative is there to attend that, and then he's killed right in the heart of Iran. So they're going to need to respond. But whether it's Hezbollah, whether it's Iran, whether it's Israel, they don't want a regional war, but they also have to send a signal that they can retaliate, that they won't allow this to pass. So it's really, can they calibrate it where they send that signal but it doesn't spiral out of control? And the difficulty is that if you miscalculate that, a regional war could be just a bombing away. So it's a very, very nervous time.
Killing Tantia, does that have pretty, severe implications for the negotiations for a ceasefire, right? Because he was sort of the, the go-to person who was trying to bring these conversations together. Totally.
I mean, he was the front man. So the Qatar said it themselves. It's hard to have negotiations when one of the negotiator is not there anymore. And that just led to a lot of upset within Israel as well, because they thought that a truce deal was close at hand and that perhaps the hostages will be released. Now that moves further off, and obviously Hamas's preparedness to negotiate is going to be reasonably limited there. But what history's shown is that these assassinations really don't change the overall picture. Everyone can be replaced in these situations. I mean, a lot of Hamas figures have been assassinated in the past, and similar with Hezbollah as well. So it's not going to change the overall scheme of things. What it does do is it boosts the prestige again of Israel's security forces, which was severely damaged in October 7 with that terrible attack that took place in Israel. But yeah, it's certainly going to set back any hostage talks, and I think that's probably going to be off of the agenda for a little while now. We're really just waiting to see how Hezbollah, how Iran, and how Hamas as well, they'll try and avenge Haniyeh at the same time too, how they respond to Israel and then how Israel responds again to that. It's a very, very dangerous time.
What have been some of the most significant reactions from international leaders?
Yeah, well, look, Israel hasn't taken responsibility for this, but and the US said it wasn't aware of it. But China has made a point of condemning the assassination and saying that it does nothing helpful in terms of maintaining some degree of stability in the Middle East, and I think that's exactly right. But by the same token, I mean, these are always judgment calls that Israel's making. What's the fallout? What's the advantage here? And these sort of assassinations are signals that Israel remains a superpower in the Middle East, basically. But yes, China was very critical of it. Qatar, obviously, as I mentioned earlier with Haidi, they were critical as well, because how do you have truce negotiations when the person across from you suddenly isn't there because they've been assassinated by the people you're negotiating with? I mean, so it does create an awkwardness, but that's just the nature of the politics of the Middle East.
Works Michael Heath there with the latest on all of the geopolitical tensions in the Middle East. We have more ahead on the Asia trade. This is Bloomberg. Keep an eye on shares of Mizuho when trading in Japan starts at the top of the next hour. The country's third largest bank reporting a better than expected increase in its first quarter profit. And of course, we had that huge rally when it came to Japanese bank stocks, rising the most since December of 2022. Of course, we had the BOJ rate hike, not to mention the reduction of bond purchases. Our Asia investing editor Russell Ward joins us here in the Tokyo studio for a breakdown of what we're expecting in the financial sector, given especially with the BOJ move now.
Hi, Shery. Yeah, so we saw that big rally in Japanese bank stocks yesterday. And bank investors and the banks themselves are very encouraged by yesterday's rate hike, but also not only that, the prospect of further rate hikes by the Bank of Japan. I think that was the big surprise, positive surprise for the banks yesterday. That's going to boost loan profitability. We saw already Mitsubishi UFJ, Japan's biggest bank, has acted to raise the short-term prime rate, which is a benchmark for mortgages, and that they're raising that for the first time in 17 years. So Mitsubishi UFJ is not wasting time in capitalizing on higher rates returning to Japan.
We are actually getting the results today from Mitsubishi, right?
That's right. So for Mitsubishi UFJ, we're actually expecting profit to drop just a little bit, but that's due to the absence of a one-time gain a year earlier. What we really are expecting is the bank to have positive progress towards its full-year profit goal. Remember, it's forecasting 1.5 trillion yen of profit, which is a record. We saw Mizuho report results yesterday that showed really good progress towards its profit goal. I think almost 40% of its full-year profit goal, and just in the first quarter alone. So, Japanese banks are seeing this tailwind with the domestic rate increases. Obviously, rates higher abroad as well. And I think that's going to show up, the domestic rate increase effect is going to show up in the earnings as the year progresses.
We're also watching Norinchukin, of course, reporting after those massive losses expected on sales of foreign bonds. What are we expecting and watching out for Notru here?
Yes, so Norinchukin, it's really the other side of the coin, and rising interest rates have not been kind to Norinchukin. Remember, this is the bank that just a few weeks ago forecast 1.5 trillion yen of losses this year. That's actually the same amount that MUFG is forecasting in profits this year. So it really sort of underscores the contrast between the regular banks and this quite unusual bank, the agricultural bank, that's really more like an investor. And so, you know, it was caught out by rising interest rates abroad, which has meant that it's sitting on paper losses on bonds that it wants to get off its book. So we'll be looking out for this year, for this quarter, to see how many of those bonds, foreign bonds, that it's actually managed to sell, how it's been rebalancing its portfolio, and also progress towards raising capital from its cooperative members to plug this hole that's been left by these paper losses. You know, it's going out to these farmers around Japan with its sort of cap in hand, you know, wanting to raise more funds from them. So it'll be interesting to see how they're progressing on that front as well.
Asia investing editor Russell Ward there in Tokyo. Coming up the next hour, here where Goldman Sachs is maintaining a constructive view on Japanese banks as the BOJ adjusts policy. Some of the other stories we're tracking this hour: United Overseas Bank reporting lower net profit in the second quarter. Southeast Asia's third largest lender says net income, excluding one-off costs, fell by 1% to around $1.1 billion. But a decline in its main lending income was cushioned by strong gains from fees, including from wealth management and credit cards. HSBC shares gaining in London after the lender reported solid earnings. Pre-tax profit for the second quarter rose to nearly $9 billion, beating the average analyst estimate of around $7 billion. Departing CEO Noel Quinn ended his final quarter in charge by announcing a $3 billion share buyback.
We're retaining sufficient to drive growth, and we're distributing any excess because we've still got a very strong capital ratio, CET1 ratio. We're quite well above our target range. Therefore, we're able to both grow and distribute via buybacks.
Bill Ackman's Pershing Square is pulling an IPO for a US closed-end fund. That's after downsizing its fundraising target and facing difficult questions from investors. Pershing Square slashed the anticipated size twice in just over a week, from an initial target of $25 billion to just $2 billion. Ackman says the firm will reevaluate its structure based on investor feedback. Coming up later on Thursday, our interview with the Rio Tinto CEO, Jakob Stausholm. That's after the miner reported first-half profit that edged higher from the year before. Catch that conversation at those times on your screens.
Take a look at how some of these tech names are trading at the moment, because of course we saw that huge gain for Meta jumping after second quarter revenue beat estimates. Qualcomm under a little bit of pressure in the after-hours session, despite the fact that they gave a strong revenue forecast for the current period. A little bit different from ARM. You can see the downside in the company, more than 10% still. They stuck with some tepid annual sales forecast, and they didn't really boost their outlook despite topping earnings. CEO Rene Haas now saying that they see weakness in certain markets offsetting some of those sales gains. And of course, we continue to watch AMD. Its CEO Lisa Su saying that the chip maker is expecting to generate more than $4.5 billion in sales this year from its MI300 products. She spoke to Bloomberg following their earnings report.
We had a very strong second quarter. We're very pleased with the overall growth that we saw, really led by the data center business. So our data center business more than doubled year on year in the second quarter, and we see, you know, a strong second half there as well as strength in PCs. So, you know, to your question about you know, MI300 and what are we seeing in AI, you know, we're seeing an environment where everybody needs more data center AI infrastructure. You know, computing is really the foundation of what drives you know, sort of all of these AI capabilities going forward. You know, MI300 has been well into the qualifications at numerous of our top customers. And, you know, what we saw over the past quarters, we passed some very significant milestones in both one, ramping up our supply chain, but also passing important, data center customer milestones where customers have moved our product into production. So it's an exciting time right now. We did update our full year AI guidance from greater than $4 billion a quarter ago to greater than $4.5 billion. I think we're seeing great traction in our hardware and software milestones. So overall, I'm feeling really good about the setup going into the second half of the year.
Lisa, I'm really interested in kind of the design and performance differences for all the AI accelerators that are out there. You and I have talked about the technology differences, but on the call, you gave the example of Microsoft and its use in the quarter of the MI300 generation. When you're speaking to a hyperscaler, when might they opt for using MI300 over NVIDIA's H100 and I suppose to a lesser extent Gaudi? What is the specification or performance driver that would make it a better solution in a certain use case?
Yeah, well, first of all, I'd like to, say that Microsoft is a phenomenal partner. They're a great partner for us, across, the data center as well as, the client businesses. And when you see, in particular, how complex these AI systems are, you want to have, the best technology capability. I can go into speeds and feeds, but I won't. I think it's suffice it to say, you need this type of computing for both training and inference. In our case, MI300 is the leading inference accelerator today. We have the highest memory bandwidth, and that's really helpful. When you're asking questions to, something like, a ChatGPT or Llama model, and you want your answers to return faster, you want the fastest inference accelerator out there. And, MI300 does very, very well in that framework. And then when you take a step back and just look at the overall AI market, I mean, the overall AI market is growing so fast. There is no one solution fits all.
We'll also be watching SK Hynix and Samsung at the start of trading in Korea. They could move on the impact by these new chip restrictions. The US is said to be considering to curb China's access to AI memory chips. They could come into effect as soon as next month. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after another rally in Wall Street with the S&P 500 seeing its best day since February. Really, markets perceiving, Haidi, the dovishness coming from Chair Powell. They seem to be ready for a cut as early as September.
Yeah, that really feeding through to some of that relief rally that we saw after the big tech-driven sell-off, right? Meta earnings also helping some of the sort of conviction that we are starting to see the payoff of AI-related investment across the results for Meta when it comes to ad sales. Clearly one of the drivers that we see across tech, but also very interestingly, of course, is the yen. Maybe just getting that kind of second leg of that rally being boosted by Fed Chair Powell's comments later.
Yeah, we're below 150 right now for the Japanese yen against the U.S. dollar. Of course, we first saw a little bit of weakness after the BOJ hiked rates in the previous session and also announced those reductions of debt. But when we got the Fed and that more dovish commentary with the Fed really concentrating on employment as much as inflation, now that there are risks to both sides, we saw the trajectory higher for the yen, which is now rallying to around that 5-month high. We continue to watch Japanese bank stocks, though, because those were the ones that rose the most since 2022 after the BOJ rate hike. We're seeing a little bit of consolidation across the market with the topics down about 1%. Of course, we continue to see the risks also around what happens on restrictions against chip makers that could be supplying to China coming from the Biden administration. Take a look at how the Kospi is coming online, because we saw those gains in the previous session together with the Korean won. Right now, we'll be watching what's happening with the trade numbers that are breaking right now. Exports year-on-year growth of 13.9%, a little bit below expectations for the month of July, but a big acceleration from the previous previous month of gains of about 5% for the month of June. Imports year-on-year also gains in the double digits, 10.5%. This leaving a trade surplus of 3.6 billion US dollars. We, of course, have seen that incredible rally when it comes to those strong chip shipments coming from South Korea, not to mention that we're seeing this increase in working days helping those numbers. But exports year-on-year, a little bit of a miss, Haidi. Growth still of almost 14%.
Take a look at what we're watching when it comes to Australia, because we had stocks on that side of things really surging to a fresh record high. The softness in the CPI number really boosting these expectations, perhaps that this is, in fact, the end of the tightening cycle for the RBA. We had that real pullback from really the bets that were being put on that we would see another hike from the RBA in August, and now looking like potential easing sooner rather than later. That core inflation really decelerating last quarter. We also saw house prices trending in the same direction in data out from CoreLogic over the past few hours as well. So we are seeing that extension of the record high when it comes to Aussie equities. The Aussie dollar holding pretty steady, actually 65.48. So I guess in that battle of dovishness, we are really seeing the Fed kind of win out there against some of these other trading pairs. Also looking at treasuries as we see that extension of that staging that month-end rally, I should say, the hopes of that September Fed cut. We also saw a bid being caught after the report of potential retaliation from Iran amidst these geopolitical concerns. Also, of course, watching that impact on oil, which surged the most since October on that very same report. But let's take a listen to what Fed Chair Powell had to say.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Let's bring in Suresh Tantia, who's the APAC strategist at UBS Wealth Management. Really great to have you with us. So clearly we've kind of seen markets run with this narrative that September and then another cut before we hit the end of the year. Is this sort of going to sustain the recovery that we saw overnight in US markets?
Good morning. I think it's quite likely that the rate cuts are going to support the equity market and the recovery in equities. If you look at the history, normally S&P has rallied close to 16% a year after the first Fed rate cut. So I wouldn't be surprised if this rally continue, given that lower rates are going to support the valuation and earnings are coming through. So we are looking at S&P going up to 5,900 by the end of this year and 6,200 by the middle of next year.
Does that mean when it comes to Mag 7 and tech-related stocks in particular that the worst is over, despite some of the more, geopolitical side of things and political concerns for chip makers?
Absolutely. I think this is time to get back into the AI stocks, into the tech stocks, given the strong earnings picture. The way we are playing the rate-sensitive parts of the market is three ways. Number one, look at the AI stocks because they're going to benefit from lower interest rate. Second, look at gold, which is going to be beneficiary of the lower rates and the buying by the central banks around the world. And third one is the fixed income market, specifically the IG bonds.
Suresh, let me turn to the Japanese market right now because we're seeing big losses for the Nikkei and the topics. Is it all about the strength of the Japanese yen? Because I thought there was a little bit more subtlety when it came to the strength of the yen being linked to, say, those exporters in Japan getting a boost.
I think a large part of that is because of JPY strength. We have seen this earlier this year when JPY was weakening. Japanese equity market did very well, and now as it has come down from 160 to 150, the Nikkei and the overall market is coming under pressure. But we won't be worried too much about that because it's not going to have that much impact on the earnings profile of the Japanese companies. We would actually buy this dip because eventually we do think there is not much downside for dollar yen from current levels, and the valuation and the earnings picture for Japanese companies look quite interesting at the moment.
What did you make of the BOJ decision yesterday? Because the initial reaction was that it was perhaps a dovish hike. But at the same time, given what the Fed has done overnight, we're seeing a little bit more optimism about perhaps the tightening moves coming from Japan and the Japanese yen.
It was indeed a dovish hike. So that's why we don't expect BOJ to hike any further this year. Only next year we expect a next rate hike coming from Bank of Japan. But the bigger driver for Bank of Japan and yen is what Fed does. And it's clear now that Fed is going to cut rate in September. I know part of the market believed the story that Fed is going to cut rate in September, but there was part of the market which was humming the song, "Wake Me Up When September Ends." But I think that's going to be too late. Fed is going to clearly cut rates in September, and that's going to drive the yen and the overall markets.
We started the conversation with Haidi on tech stocks. What are we expecting about tech stocks here in this part of the world, in Asia, given that we continue to see the geopolitical tensions around chip makers?
I think we have to differentiate between the tech stocks in Korea and Taiwan and in China. I think Korea and Taiwan stocks continue to do well because of the cyclical tailwinds, and they are less exposed to the geopolitical risk. On the other hand, yes, Chinese tech stocks could be under pressure because of the concern, but at the same time, good news is that the valuations are very cheap and the earnings for Chinese tech stocks are recovering. So there is a short-term trade available for the Chinese tech stocks as well.
Would you be going more into bonds for safety at the moment, given some of the political and geopolitical concerns that look like are going to sort of keep playing out over the next few months?
Not just because of the geopolitical tension, but also because of the fact that Fed is going to cut rates. Our messaging to investors have been, don't lose forest for the trees. Most of the investors have been focusing on when the Fed is going to cut rate. We have been advising investors that they need to focus on the cycle. Once the Fed start the cutting cycle, it's going to continue for the next 12 to 18 months. So yes, geopolitical tension is one rationale to buy bonds, but also the fact that the economy is slowing down, inflation is moderating. So as Fed cut rates, bonds are going to rally. So it's not too late to get on board the bond train. I think there are further gains ahead for the bond market in the next 6 to 12 months.
Suresh, Tantia, good to have you with us. APAC strategist at UBS Global Wealth Management. Take a look at how chip makers across Asia are trading right now, because we had a lot of geopolitical news overnight about the U.S. potentially considering unilateral restrictions on China's access to AI memory chips, and sources saying that that would be designed to keep Micron, SK Hynix, and Samsung Electronics from supplying Chinese firms with those advanced chips. You're looking at Samsung and SK Hynix really going along with a broader trend on the Kospi that's gaining ground about 0.6%. Tokyo Electron, we had already seen some gains for this company because we heard that the U.S. could be preparing to exclude makers in Japan as well as the Netherlands. We're seeing those gains of about 0.4%, Heidi.
Yeah, and Shery, we are watching that sort of play out when it comes to treasuries as well. Some of the risk aversion really, again, just creating another reason for the extension into the end of the month, right? The hopes of that September Fed cut. The jobs report on Friday is now very much in focus. We're seeing swaps traders still pricing in 2 rate cuts in 2024. So the rally that we've seen across US treasuries capping now a third straight month of gains. This is now the longest winning streak for US bonds in about 3 years. We saw sort of yields falling some 10 or more basis points really across the curve after we've heard from the Fed chief saying that the time is coming to start lowering borrowing costs and to start thinking about that as well. We saw later on in the session, of course, that then getting even more of a boost with these Middle East tensions, stoking some of that haven buying with this report about a retaliatory attack being ordered by Iran. So lots to watch out for as we head into the end of the week. And of course, we're not done yet when it comes to central banks. We've got the BOJ, we've got the Fed, and also now looking ahead to the Bank of England as well. More ahead on the Asia trade. This is Bloomberg.
We continue to watch Asian chip stocks in the trading session today. The U.S. said to be considering new restrictions on China's access to AI memory chips and equipment, a move set to further escalate their tech rivalry. For more, our China correspondent Mimi Lo joins us in Hong Kong. And Mimi, we're hearing from sources that these could be specifically designed against the likes of South Korean makers like SK Hynix and Samsung. What exactly would be the U.S. authority to do this?
Yes, well, these new rules are targeted at limiting the sale of these cutting-edge chips that are required for artificial intelligence, which is the new tech frontier of the race between U.S. and China. And these are your HBM, the high-bandwidth memory chips that are produced by companies like SK Hynix, Samsung, and Micron as well. These are the chips that are required in those AI accelerators that are offered by companies like NVIDIA. So if this rule is enacted, those companies will not be able to sell not just the chips, but also the tools that are required to make them to China. Now, the U.S. is likely to invoke the FDPR, the Foreign Direct Product Rule, that allows Washington to impose controls on foreign goods that rely on even the tiniest bits of American technology. And we know SK Hynix and Samsung, they rely on U.S. chip design software. Micron is less likely to be affected because they have largely been refraining from selling those HBMs to China after Beijing had banned Micron from critical infrastructure in China. And this is part of a broader push to limit China's development in these tech frontiers. We know China now has the ability to make those HBM2 chips, which was first commercially available in 2016. The broader rules will also impose sanctions on over 120 Chinese companies. They will be listed in the so-called entity list that would designate them as a national security threat. And the Biden administration is also looking to compile a list of critical components that China will need to make semiconductors as well.
Could there be exemptions for allies?
Yes, so this was first reported by Reuters, and the U.S. is considering exempting countries like Japan and the Netherlands, and that means Tokyo Electron and ASML could be unaffected for now. And experts, though, however, are warning that investors could be mistaken by bidding those stocks higher now because those companies may not necessarily be freely trading with China. These companies may be exempted because they are the ones that are most likely to align with the U.S. anyway, without the need to invoke this FDPR rule. There's also the flip side argument that the FDPR could backfire if it incentivizes these companies to invest in their own technology and stop relying on any American components. And there's obviously also pushback from these companies as well because China is a very important market for them. And incidentally, the U.S. is also facing pushback from their own domestic American companies who say that these restrictions, they are carrying the heavier burden of these restrictions because China can still access technology from other countries. So there's plenty of negotiation and considerations from different quarters, and I think we need to wait and see what the final package will look like and what the final implications would be.
Our China correspondent Mimi Lo, as we're getting now breaking news from Applied Materials. It was informed by U.S. officials that it won't be receiving CHIPS Act money for a long-anticipated R&D center. The company had hoped to get U.S. funding for the $4 billion facility in California, an effort that it began promoting more than a year ago. And this would have been through a program designed for large-scale chip manufacturing sites. But we're now hearing that from sources, the Commerce Department officials rejected it on Monday after concluding that the project didn't qualify. Now, it isn't necessarily unusual for these rejections for CHIPS Act grants, but what stands out is, according to sources, that given how closely aligned the project is with the Biden administration's goal of reviving the domestic semiconductor industry, given all of the tech rivalry that we've just been talking about, this rejection by U.S. officials of this money from the CHIPS Act for Applied Materials is consequential. Haidi.
Shery, we're also watching crude markets at the moment, of course, that reaction continuing to be sustained largely on some of the political developments and the risk of further tensions in the Middle East. Really, that surge we're continuing to see, the most since October in that Wednesday session, the report that Iran's leader has ordered a retaliatory strike on Israel for the killing of a Hamas leader on its own soil. We also have kind of the built-up demand-side issues as well, where we saw the weekly decline in US stockpiles, the longest losing streak since January 2022. But let's get back to some of these geopolitical elements. And the New York Times was the report saying that Iran's supreme leader has ordered a direct strike on Israel in retaliation for the killing in Taiwan of Hamas's political chief. Let's bring in Bloomberg's Michael He. So it does feel like we're sort of at the precipice of something that is potentially going to widen this conflict that was a pretty big day when it comes to what Israel did.
Yeah, I mean, two successes from Israel's point of view, assassinating a senior Hezbollah official after the attack that killed young people in Israel, and then the assassination of the political leader of Hamas in Tehran. And it was very, very embarrassing for Iran that assassination occurred. I mean, he was attending the inauguration of Iran's president, who was saying he wanted to reach out to the West and maybe get sanctions rolled back. And one of the guests, Hamas's senior leader, is hit by a precision-guided missile. Israel obviously hasn't taken responsibility for this. It never does in these situations. But given the nature of the attack and where it occurred, just the way that things work in the Middle East, Iran is almost obliged to respond. The question is how they calibrate that. Can they do it whereby they fire on Israel and Israel doesn't feel like that is an intensification of the conflict and everyone sort of can maintain the status quo. The reality is that neither Hezbollah or Iran wants an expansion of the war. But in the Middle East, you have to be seen to be strong, and so you have to respond in these situations. And the question is a miscalculation. You go too hard, or there's an accident and civilians are killed, and the pressure for a stronger response from the other side builds as well. So we're in a really, really dangerous situation, and the oil market, I think, reflects that.
What's been the international reaction coming from global leaders?
Yeah, well, the US, Shery, has said that it wasn't aware. I mean, it's made clear that it had no part in this. It wasn't aware of it beforehand. But China, interestingly, was quite critical of it as well. That this did nothing for the stability of the Middle East, which is very true, obviously. But Israel would argue that it had vowed after October 7th that it would pursue Hamas's leaders wherever and target them wherever it could. So China was critical of it. Qatar as well, because obviously we've had these negotiations that looked like they were making some progress in terms of a truce and potentially releasing some hostages. And as Qatar's spokesman said, you can't, it's fairly hard to have negotiations when one side assassinates the negotiator on the other side. You're sort of left with a party of one in these talks. So yeah, the criticism from, I guess, the expected parties and pretty much silence on the other side. And as I mentioned, while Israel took responsibility for the strike on Hezbollah in Beirut, it hasn't said anything about the attack in Iran.
Do we know what an Iranian response might look like in terms of, is it direct? Do they sort of coordinate something with the various proxies, I guess, across the region?
Yeah, well, that's the question, because Israel has sort of upset the apple cart in terms of Hezbollah, in terms of Hamas and Iran. So you've got three of them there, and presumably they would coordinate it, but they also are standalone entities as well. I mean, Iran doesn't necessarily totally control what Hezbollah or Hamas do too. So they may coordinate. When this happened in April, when a senior official in the Iranian Revolutionary Guards was assassinated, the Iranians responded, but they made clear ahead of time what was going to happen, and the US and Western allies managed to help Israel shoot down most of these missiles and projectiles that were sent. Now, whether that will happen this time remains to be seen.
Performative, didn't it?
It was, and then Israel responded by hitting a base, a sort of a remote base, and it was made clear on both sides we don't want to go any further on this, and everyone understood where they stood in this situation. This is the difficulty. Will everyone understand where they stand in terms of the strength of the response here? And that's what everyone will be focusing on.
Bloomberg's Michael Heath there with the latest. We're also still focusing, of course, on more central bank action to round out the week and take a look at how, as we head into decision day for the Bank of England, how European futures are trading at the moment, looking like they're sustaining the rally we saw in the Wednesday session. Of course, in particular, we saw some very strong gains in tech, semiconductor stocks in particular, the likes of ASML. They're surging as much as 11% after that report that we could see a number of exemptions to the chip equipment makers in that part of the world from these upcoming export restrictions targeted at China. We're watching the BOE, of course, tilted towards that first rate cut since the pandemic. The expectations, not a whole lot of guidance that we're seeing from the BOE going into this decision. But we are seeing broad upside. DAX futures are up by about just about 0.2%, trading in Germany as well. More ahead on the Asia trade. This is Bloomberg.
Take a look at some of these companies trading right now because, of course, it's earnings season. We are expecting Toyota to report quarterly operating profit today, on track to exceed forecast because of a weak yen, helping fuel strong sales in the North American market. Mizuho already, we saw that unexpected gain, better than expected increase in quarterly profit, mostly because of that strong performance in its lending and trading businesses. But the stock right now is down 0.8%. Of course, we had a strong rally in the banking sector after the BOJ normalizing steps in the previous session. Advantest gaining ground the most since May earlier this year on results. Same for Panasonic, which is down 9% on earnings. Heidi.
Yeah, take a look at what we're watching when it comes to trading across currencies. And the yen is really just a fascinating story, right? Potentially, are we seeing kind of just the start of this renewed yen rally there? We saw some sort of momentum following, of course, a BOJ's move, which was surprising to a lot of people. And that took some time to sort of gain momentum, right? And we saw that sort of doubling down following the Fed as well. The yen still on that strengthening path, with the dollar yen down by just about 0.25%. Past 150 is where we're at the moment. But that gap in rate expectations between the yen and the greenback, the narrowest in about 2 years. But we'll continue to kind of watch for what further drivers we could see in the aftermath of these two key policy decisions. Watching the yuan as well, also catching some of that downside in the dollar. And we've seen that sort of extending the gain on these dollar sales, and also lower demand for the greenback as well, despite, of course, some weakness when it comes to factory activity for the third month in July. Euro dollar in focus as we get into Bank of England decision day. This is Bloomberg.
We saw Powell talk about in his congressional testimony when pushed on the dual mandate. He said, listen, this is the thing that keeps me awake at night. The number one thing that keeps me awake at night is that overshooting, the over-tightening. So that is in there, and that is what opens the door a crack, not wide open, which is what we expected for September. And I do think they're going to move in September.
If we do get the cut in September, as I think we in markets expect, it will be because they expect inflation ex ante to continue to fall.
The market's already pricing in September with a high degree of certainty. What are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a lot of difference. But I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
This is very much setting the table for September. And the bond market had already priced that outcome. And so what you look at into Friday and the payroll is you're setting up the bond market, perhaps broader markets, for a very asymmetric outcome. If the data is much, much stronger, then you're going to have some disappointment.
So my guests are weighing in on what the Fed's next move, and of course markets are broadly expecting at least 2 cuts from the Fed before the end of the year. Take a look at how Asian markets are reacting, really picking up on that rally on the Fed cut hopes, and of course this climb in the yen is really one of the factors that perhaps is driving that downward sentiment for trading in Japanese stocks at the moment. The cost be up by 0.5% there to the tune of 0.5% higher when it comes to Australia as well, extending that record closing high that was secured on that Wednesday session. Some of the pulling back of worries of more hiking from the RBA really now put in place by the weaker than expected CPI and also the property numbers as well. Taking a look at just data crossing the Bloomberg when it comes to some PMI readings from across Asian economies, and this is a picture as we see in particular Thai manufacturing PMIs a standout there, rising to the highest since June 2023. Some on the other side of the spectrum, Indonesia though, manufacturing activity there falling to the lowest since August 2021 there. We're seeing sort of just that disparity between relative strength in the likes of Vietnam, for example, firmly in growth territory. South Korea also maintaining most of those gains there as well as the Philippines seeing just a little bit of a shift lower there, but certainly weakness for Indonesia, also weakness for Japan as well at 49.1. Just another kind of data piece to make it quite interesting in light of the decision to hike yesterday.
And take a look, Heidi, at how financials are trading across Japan, because, of course, we had the BOJ rate hike, not to mention more details of the reduction of bond purchases here, and we saw that rally in the previous session. We're seeing a little bit of consolidation broadly on the Japanese Topix Bank Index at the moment, but this, of course, after a gain in the double digits year to date. We had also some upside surprise when it came to the Mizuho financial reporting profit, surprising to the upside. We saw some strong performance on their lending and trading businesses. We are getting some earnings results also from MUFG today, Mitsubishi UFJ reporting later in the day. Let's bring in our next guest who remains constructive on Japanese banks. With us now is Makoto Kuroda, Japan financials analyst at Goldman Sachs. Makoto, great to have you with us here in the Tokyo studio.
Thank you. It's a pleasure.
So let's talk a little bit about what happened with the BOJ and how much more of a boost that could give to Japanese banks.
Sure. So BOJ has raised the policy rate from 10 basis points to 25 basis points yesterday, and additionally also decided to reduce JGB purchases by 3 trillion yen per month in 2 years. And so the impact this has on the banks is quite significant. It means wider loan deposit rate spread. It means higher JGB investment yield. All told, we think that it has about 20 to 30% profit impact in the medium run.
When it comes to their portfolio management for the banks themselves, because of the debt purchase reductions from the BOJ, are we going to see them switch to JGBs more?
Yes, the shift from cash to JGB is certainly a driver of higher asset yield for these banks. And moreover, the JGB portfolio has been reduced by the banks in preparation for this rise in yields. So they're hungry to buy more JGBs and at higher yield. That's certainly a large component of the interest rate sensitivity of banks.
Do they have enough assets to do that, or are we going to see them pull money from overseas perhaps?
No, there's sufficient cash on the balance sheet. The loan deposit ratio of these banks is about 60 to 70%. Under the years and years of quantitative easing, there's been a huge buildup of cash on these balance sheets. So there's plenty of room.
What are the risks in terms of seeing the Japanese economy, for example, given higher rates? If we see a hit on Japanese consumers, on investments, could that be a downside risk for these banks?
There's some discussion of the impact of higher rates on the consumers and corporates. However, this is by and large a relatively unlevered sector of the economy, and the rise in yields, especially at these current low yield levels, is unlikely to impact the debt repayment ability of these players.
What are your expectations when it comes to, or I guess assumptions when it comes to where the Bank of Japan goes from here and the rate picture and how that affects mega banks in particular?
Sure. So notably at yesterday's BOJ, the policy statement mentions that the BOJ remains on a tightening path if the growth and inflation conditions discussed in the Outlook report remains fulfilled. That, we think, means future rate hikes. We forecast a January hike of 25 basis points to be followed by semi-annual hikes thereafter. And what that means for the banks is, again, continued rise in TIBOR, lifting floating rate loans, but also short-term prime rate is a new development. Mitsubishi UFJ Bank has lifted its short-term prime rate for the first time in 17 years yesterday. If that is followed by other banks, that could have a potentially higher profit impact that market hasn't priced in.
Norinchukin is a cautionary tale in what happens when you bet wrong on interest rates, right? What are you watching out for in these numbers? And do you see that sort of thematic being a risk for any of the other smaller or regional or rural banks?
Sure. So I think you're referring to the downside risks, which is the unrealized loss on bond portfolio. However, the banks have certainly had expertise to build in the last 10 years in terms of the interest rate upside risk. Durations have been reduced, hedges have been put in place. Relatively, the banks approach this juncture with a pretty clean balance sheet.
When it comes to all of these financials across Japan, we have seen, broadly speaking, a lot of optimism about the stock market because of corporate governance, perhaps some cross-shareholding unwinding as well. Is that what we're seeing in financials as well?
For sure. There's been cross-shareholding unwinds taking place since about 2014, but right now it has accelerated because corporate attitudes towards cross-shareholdings has really begun to change. So the banks are reducing cross-shareholdings by about 10% a year, and there's some upside risk to this.
What was really interesting was how the U.S. election has also played into the banks, especially in 2016 with the election of Donald Trump, for example. Topic's banks index actually gained ground. Tell us about the link here of how this translates into some support for Japanese financials.
Sure. While the outcome of the U.S. election is still uncertain, we have the example of 2016 to look back at. So in 2016, the bank shares, particularly Topic's Banks Index, rose about 10% in the literally 2 weeks after the elections, and then 30% in the months after the elections. And this was one of the strongest outperforming sectors of Topic's. Some of this was driven by expectation of regulatory deregulation in that time in the U.S., reading across to global banks. There is a somewhat read across to be made for that theme this time, but it's also coupled by this very favorable interest rate environment.
What are the risks then?
The risks to the bank thesis is probably widespread global economic downturn, or perhaps more aggressive U.S. rate cuts than expected. But the thing is, the bank's guidance already expects a certain number of U.S. rate cuts in this midterm plan. So there's a lot of buffer to the guidance.
Makoto Kuroda there, Japan Financials Analyst at Goldman Sachs. Really great to have you with us today. Some of the other stories that we're tracking at the moment: United Overseas Bank has reported a lower net profit in the second quarter. Southeast Asia's third largest lender says net income, excluding one-off costs, fell by 1% to around $1.1 billion. But a decline in its main lending income was cushioned by strong gains from fees, including from wealth management and credit cards. HSBC shares gained in London after the lender reported solid earnings. Pre-tax profit for the second quarter rose to nearly $9 billion, beating the average analyst estimate of around $7 billion. Departing CEO Noel Quinn ended his final quarter in charge by announcing a $3 billion share buyback.
We're retaining sufficient to drive growth, and we're distributing any excess because we've still got a very strong capital ratio, CET1 ratio. We're quite well above our target range. Therefore, we're able to both grow and distribute via buybacks.
Bill Ackman's Pershing Square is pulling an IPO for a US closed-end fund. That's after downsizing its fundraising target and facing difficult questions from investors. Pershing Square slashed the anticipated size twice in just over a week, from an initial target of $25 billion to just $2 billion. Ackman says the firm will reevaluate its structure based on investor feedback. We are counting down to the market opens in Hong Kong and mainland China. Investors are anticipating more pro-growth measures from China. And in fact, if you take a look, the onshore benchmark gauge capping its best day on Wednesday in nearly 6 months. Let's get more from our Asia stocks reporter Zhang Cheng. And I should point out, best day in 6 months and seemingly without much support from the national team either.
So we did see a bit of a nice rebound in Chinese stocks yesterday, and that was after initially traders were a little bit disappointed by the Politburo statement, which stopped short of offering any strong stimulus measures, but it did mention that the Chinese government is going to stimulate consumer spending and also potentially use more counter-cyclical measures. And after a day of digestion, I think some traders are coming to realize that maybe there's a possibility for further easing measures by the Chinese government, and that's really spurring the positive sentiment. And we also probably saw a little bit of short covering there. So, and also we did see more signs of the national team participating in the stock market to, really support that sentiment. We saw some ETFs tracked by the national funds really, seeing a spike in activity. So that probably offers some floor to the sentiment as well.
And yet at the same time, we've recently gotten more news that China could be stopping publishing daily global stock market flows starting mid-August. So how much can we expect the confidence to be there in the Chinese markets when the transparency is still an issue?
I mean, definitely for global investors, they are losing an important measure to sort of track the sentiment in Chinese stocks, and that's definitely a bad thing. But in terms of further catalysts, I think that it really lies on whether there are further easing measures from the Chinese government, whether it's in terms of, triple R cut or LPR cut or more fiscal measures. And we also really need to see that local consumer sentiment stabilizing before, there can be a more meaningful upside in Chinese stocks. Consumer sentiment has remained weak and the property market is showing little signs of improvement. So we really need to see some concrete improvement there. And also, as we enter the second quarter earnings season, for individual companies, it will be a great chance for investors to gauge whether there's, a further upside in earnings revision. So that would be very key to, the short-term outlook for Chinese stocks.
Asia Stocks reporter John Chang there, watching to see whether this kind of revival that we've seen perhaps could be sustained for Chinese equities and risk sentiment. Take a look at the picture when it comes to bonds, right? We saw treasuries just extending into that month-end rally on the back of these dovish comments that were perceived from Fed Chair Powell, and now these expectations really of at least 2 cuts as early as September being started with this easing cycle, but certainly 2 before the end of the year is what markets are looking at the moment. A little bit of a divergent play when it comes to bonds trading around Asia, though, as well. We're still kind of seeing that reaction when it comes to Australia. We saw that big jump in the bond market earlier with the weakening in the Aussie dollar as well. A little bit of a reversal in that trade. A lot of this due to core inflation unexpectedly slowing, that sort of repricing now of no expectations really going into that August RBA meeting for another rate hike to be on the table. Also watching Chinese bonds as well as we get the sort of developments when it comes to the PBOC looking like they're sort of stepping aside for bond bulls, right, as this rally regains momentum. The pro-growth signals that we've heard from the Politburo meeting, the kind of inaction when it comes to the PBOC as well. So really seeing perhaps a lack of intervention there, giving a bit more of a go-ahead for that market. More ahead on the Asia trade, this is Bloomberg.
The The Chinese city of Wuhan is shaking off its COVID stigma to position itself as a leader in smart car technology. But its experiment with driverless taxis is also putting thousands of jobs at risk. China government reporter Colin Murphy has been in the city taking the robotaxis for a ride. So what exactly is going on in Wuhan, Colin?
So yeah, there's about 500 vehicles on the road right now, and the plan is to expand that to 1,000 by the end of the year. And the key point here is that it's actually one of the largest rollouts in China for sure, and it's integrated into the city life and people's life in a way that wasn't maybe the case before. You will remember that there are various pilot tests happening in different parts of the country and indeed around the world, but this is in a more integrated way. It's taking people from places that they want to go to, or from places to places that they want to go to, and they can do it by using an app. It's attracted an incredible amount of attention on Chinese social media and also internationally as well. So it's attracting visitors that are going to Wuhan specifically just to try it out. And I went there myself recently and took a ride to see what all the fuss was about.
So what did you make of all the fuss, and does it mean, these are cars made by Baidu, of course, does that mean they've got a lead when it comes to the delays we've seen from Tesla and Waymo?
Right. Well, first of all, I'd say the experience was quite exciting. A lot of people do sort of have some apprehension at first, but I think once you get used to it, it sort of becomes less daunting. But in terms of the technical advantage or technological advantage, it's kind of really hard to say at this point, like which country is leading. The US did have some rollouts earlier, and in that regard can be considered to be ahead. But I think one of the key areas is the regulatory framework, which is much more developed in China, but also the sort of the signaling coming from the top that this is an industry that China is definitely keen to pursue, and that sort of clear vision from the top, I think, is very, very important, because it allows investors, it allows entrepreneurs to really know that this has a future. This is something that the country really wants to exceed in and excel in
China
as well.
government
Yeah,
reporter.
so I think the signaling is important.
Colin Murphy there, our China government reporter. A great story. In fact, one of the complaints from residents is that they drive too safely and therefore too slowly. Well, in the meantime, BYD's ADRs closed higher following news that the Chinese EV maker is looking to enter the Canadian market. Lobbyists for the company have filed notice just as the Trudeau government wraps a consultation on measures to restrict Chinese imports. Meanwhile, Uber will team up with BYD to put 100,000 EVs onto the ride-hailing company's platform. The tie-up will start in Europe and Latin America, but will not include the US. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to Taiwan futures. This is we continue to really monitor the effects that we're seeing across semiconductor-related stocks in particular. Right, we're watching TSMC with the number of TSMC investors sitting at that record high. So that's one to watch as we get into the start of trading in Taipei. Really this idea of kind of this stock in particular sparking the patriotic spirit of the Taiwanese. The chip maker has been dubbed the holy mountain that safeguards the nation. We're seeing retail shareholders reaching a record this year. So watching that, let's get some more from our Taiwan markets reporter, Betty Ho, who joins us now from Taipei. So Betty, what are we hearing when it comes to this swelling of retail investors that are particularly interested in TSMC?
Right. So on the ground in Taiwan, we're seeing a lot of retail Taiwanese investors buying the TSMC stock, basically based on the belief that they think investing in TSMC is what they can personally do to protect Taiwan from any foreign threat, and also from a Chinese invasion even. If you look at the data, the TSMC's retail investor holding is at a record high. Also, these retail investors don't seem to be affected by the recent foreign sell-offs in the TSMC stock because data has shown that especially when the stock is kind of going through a retreat because of foreign investors selling, the all-out trading, which is largely contributed by retail investors, actually also jumped to a record high. So it is we're seeing a lot of retail support here, and you're right. So people here call TSMC the holy mountain that safeguards the nation, or the silicon shield that protects Taiwan from China.
We know how fickle the markets can be. We've seen this huge rotation out of major tech stocks in the U.S. So what are the risks with investing in this stock?
Exactly. So some fund managers and some institutional investors are already warning about the risk of valuations getting a little bit too high for TSMC. The price forward earnings is already trading at some 20 times, which is slightly higher than the 5-year average. And also, investors need to keep in mind that TSMC is still largely owned by foreign investors. So foreign investors essentially hold over 17% of the stock. So retail investors need to be aware of that.
Betty Ho in Taipei, our Taiwan markets reporter, with the latest on TSMC, which will be one of the stocks that we'll be watching when the markets open in China and Hong Kong. That's it from the Asia Trade. Our markets coverage continues. This is Bloomberg.